Welcome. I'm Amy Hogan, and this is the Commodities Dig. Asset sell-offs, lower valuations, and dried up public funding has led to opportunity for private equity in the mining industry. But there's been a lot of talk and not a lot of action. Are valuations not low enough yet for private equity? Joining me today is Gareth Turner, Senior Partner, Head of Mining and Metals Principal Investment at Apollo Capital Management. Welcome, Gareth.
Thanks, Amy.
Due to the current deals market right now in mining, what would you say the pipeline looks like for opportunities to invest in the mining industry?
For private equity, it's very active right now, and I'd say that for myself and probably for our competitors. There's not much traditional merger activity. There is a wall of capital needs building up, and a pipeline is growing day by day of large companies looking to raise capital to delever, or development companies looking to raise capital to bring their project into construction. And they've been shut out of traditional public debt and equity for over 15 months. So the pressure on these companies to now raise capital before the value destruction becomes more significant is growing day by day. And I think that sets us up for a very good discussion. We're a solutions-based provider of capital. We're willing to work with any counterparty in a very flexible format. And so it's been a very long summer. We've been very busy. And I hope a year from now that we'll have 2 or 3 very interesting deals to talk about where private equity has been the unique solutions provider for a company's capital needs.
What is the value that private equity could add to a mining company over, say, other alternative forms of financing available in the marketplace right now for mining companies?
There's 2 elements to that. One is the nature of our investment. Secondly, the value added, post-completion. I think our capital is very flexible. There's no immediate need to return it. There's no, we can invest for 3, 5, 10 years. Whatever the natural horizon is for the investment, we can invest for a very long term. And it's very flexible. We can invest in common, we can invest in preferred, we can invest in debt. So there's a lot of ways we can bring capital into the company, which creates a lot of flexibility. That's the first thing. And the second thing, which is different versus a traditional institutional investor, is we take an ongoing role to help manage and support our companies. And as part of our responsibility of managing our investments, we bring our collective experience to bear of the entire team, which spans over 50 years of total experience in the industry. Yes, it's not been from traditionally an operating perspective. It's more been from a financial or capital markets perspective. But we've analyzed literally hundreds of companies and seen what's gone well and what's not gone so well. And I think that expertise and that range of knowledge and that unique vantage point into these companies can be very value added at the board level.
So building on your comment about your ability to work with management teams and bringing value that way, who are your biggest competitors in the marketplace in terms of competing for the hot assets that are out there right now?
Everyone wants to talk about China because China is significantly deficient in natural resources. So any major mining asset that typically comes into the marketplace today, there's always a question mark of will there be a Chinese buyer. And in many cases I have to concede that for strategic reasons a Chinese buyer can be the best buyer. But there's often cases where the Chinese buyer does not want control, will only want a minority stake or secure the offtake from the mine, which in many cases if a buyer is looking to sell control or 100%, the Chinese buyer is not the natural buyer. So we have been in competition with them. We've been in partnership with them in some transactions. So it really depends on the situation as to whether the Chinese buyer will be the natural best buyer. And often there's political considerations for, let's call it politically sensitive assets, where there's impediments to a foreign buyer buying domestic assets, whether that be in the US, Canada, and Europe. There's that hurdle for a foreign buyer to overcome as well.
You were quoted recently saying there are not too many places you can go to raise $200 to $300 million in a phone call. Can you expand on that?
Yeah, I probably can. It probably was too low. I mean, it's 200 to $1 billion because we've invested as much as $1 billion in certain resource opportunities. But what I meant by that quote is if we see a company we like and an opportunity we find attractive and a management team that we can support and a board that we can work with, we can move very quickly from an initial call where there's a defined capital need to closing a transaction in 2 to 3 months. And literally, these transactions start with one phone call. And we'll put a team on it, and if we find it really interesting, we'll prioritize that as an opportunity, and I think we can move very quickly. And we don't need to syndicate the equity. We can speak for all 200 to 300 million, or in some cases up to $1 billion, and provide single source execution for the counterparty.
So then what would you say, in your opinion, is the biggest roadblock for mining executives when they're considering private equity?
I think there's two things that make my job a little bit more difficult. One is just the level of understanding of what we do and how we do it. And that will be overcome over time, and we'll spend more time with companies and they'll understand that we can be a good solutions provider for their capital needs. I think the second thing, which has been an issue in the past, is the equity markets have been the natural, most cost-effective source of capital for mining companies. And that came to an abrupt halt in the second quarter of last year. And for the last 12 to 15 months, the markets have been effectively shut for traditional mining companies raising public debt or equity. So we've become a very natural alternative source of capital, and one that people now actually are trying to embrace and trying to pursue as a way to solve their capital needs.
Okay, so then my last question for you is, where do you see the market going in the next year in terms of deal activity in the mining industry?
Well, I think there's very little M&A going on right now because everyone's feeling very defensive. There's a lot of uncertainty about China and its long-term growth rate. People are talking about 7.5% being the new normal. Some people are projecting lower growth, like as low as 5%. And what does that all mean, for the future for commodities? Against that, you have a number of large-scale new mining projects which are coming into production over the next 2 or 3 years. So that's created a lot of uncertainty in people's ability to forecast in the next 2 to 5 years. In that environment, it's about as good as it gets for us because we take a very long-term view. We're not as focused on the price today or in 3 months or 6 months. We're thinking very long-term in terms of commodity prices. And we're looking to basically invest in high-quality companies at fair prices. And today, the valuations are at a level we feel comfortable committing capital to. And if it takes a while, 1 to 2 to 3 years for the public markets to recover and for us to realize the value of our investments, we're totally comfortable with that, as long as we're backing a good management team with a high-quality company.
Thank you so much for joining me today. The mining industry will be waiting with bated breath to see what happens in the deals market in the next few months, particularly in regards to private equity. Thank you.
Thanks, Amy.
I'm Amy Hogan. This has been the Commodities Dig.